Two numbers can cost you thousands when you roll your money over. That's the number 20 and the number 60. Now, what am I talking about? When you have a 401k and you want to roll it over, 20 and 60, those two numbers, if done wrong, could cost you tens and thousands of dollars in your retirement funds when it comes time to move that money over. So I'm going to break it down for you guys. Understand, every year, you know that millions and millions of people, they're changing their jobs. Either they're going to retire, right, or they want to go to a whole another career field. And then here's the problem: almost everyone has this problem. What am I going to do with that old 401k plan? And I know what you're thinking. Look, man, it's simple. I could just move it, right? Not worrying about anything. But here's the truth, folks. I've been licensed for the last decade. I see it happen so many times. And that one small step, if you do it wrong, you could trigger taxation, penalties, loss of compounding growth. And that's the 2060 rule. Now, it was Fidelity back in 2024. They had a retirement trends report, and they said that Americans lose about $1 billion every year, a billion with the B every year, because you guys just mishandle your rollovers. All right, we're not talking market loss. We're talking about a procedure error. You moved everything over. You did it wrong. It's 100% preventable, but it still happened to you. So let's break it down easy. You have the 20% rule, and then you have the 60 rule. Now, the 20% rule is what is the withholding trap. Once you have your money, let's say you got $100,000. I want to leave the job. I'm not there anymore. I'm not trying to roll everything over. I just want to take the money out. Well, if you take your 401k balance as a check that's made payable to you, you don't pay it to another company, you pay it to yourself. Your employer is legally required to withhold 20% for federal taxes. So you had 100,000. When you see that check really hit your account, it's going to be $20,000 short. It's going to be 80,000 in there instead of 100,000. Now, what does that mean? The other 20,000 is going to go straight to the IRS, whether you intend to withdraw the money or not. That's an indirect transfer. Okay. Now I know what you're thinking. Yeah, that's fine. They could do that, and if that's the case, I'll just roll it over, no problem, instead of taking the money out. But here's a catch: if you want to keep all that 100,000 we're talking about, if you want to keep it tax free, you need to deposit the full amount, 100,000, right, into the new qualified plan that you rolled over. That means what? You're going to have to come up with that missing 20,000 out of pocket. And folks, I've seen it happen. I've been licensed for the last decade. I've seen it happen time and time again. This happens and they're thinking about it. But look, if you can't come up with that money, that withdrawal amount now becomes a taxable distribution. And possibly on top of that, it could be a 10% early withdrawal penalty if you're under the age of 59 and a half, because you did everything wrong. They withheld the money. You decided on rolling it over. You had to come up with that. That's a small oversight that could cost you thousands. It could cost you tens of thousands of dollars, folks. Tens of thousands in taxes and just lost time of compounding. Your money could have been compounding and you lost that time because you had that 20, right? The 20% rule. Now, the other part of it is 60. It's the 60-day rule, and the 60-day rule is the deadline, all right? It's the deadline that hurts, and I've seen it happen to a lot of people, because some people, they just waited too long. Some people got greedy. They got the check in their hand. They wanted to do other things. But the 60-day rule is the IRS, folks. The IRS gives you 60 days from the day that you receive the check to deposit that money into another qualified account. Meaning, you're trying to do a rollover, they give you a check, but you have 60 days to move it. And if you miss that deadline even by one day, guess what? Now the entire amount, say that entire 100,000, becomes fully taxable income for that year. So you made 50,000, you got $100,000 check. That means you're going to be taxed on 150,000. So not only can it bump you into a higher tax bracket, but it also creates a large unexpected bill coming April. You know how a lot of people hate April 15th? Yeah, There you go. For retirees now, it could even affect your Social Security taxation, all right, or your Medicare premiums. So that's huge. I had a client maybe 3, 4 weeks ago that happened to them, and they're going to feel it when Social Security comes around. So between that 20% withholding rule, all right, and the 60-day rule, put those together, it's easy to see why so many people I've seen tripped up. One small mistake, and the IRS, right? They're going to treat your rollover like it's a withdrawal, and now you can't do anything because we call it the IRS. Put it together, the IRS spells theirs. They're going to get theirs. All right. So here's the fact. It's a simple fix. Is do a direct rollover, folks. Don't do an indirect. Do a direct rollover. One of the things I specialize in. Now the good news is when you do that, you avoid that whole mess, making everything incredibly easy. So what does that mean, folks? Instead of requesting a check that's made payable to you, what you're going to do is ask for a direct trustee to trustee rollover. Okay, a trustee to trustee rollover, which is under the IRS code 402C. IRS section 402C is the approved method that's literally used for retirements to move money in a direct way, safely, not worrying about taxation and penalties. So if you have a direct rollover, your old plan, right, it sends funds directly to your new plan. If it's a new 401k, IRA, annuity provider, whatever it is, you never touch the money, which means there's no 20% withholding, there's no 60-day rule, and there's no penalties, because that messes up so many people. Look, it's clean, all right? It's smooth, it's clean, it's automatic, and it keeps your tax deferred status intact. And that's huge. Now, that's one, all right? That one extra form or that one check box, it could save you thousands of dollars. And people don't look at it like that. That one box checking from direct to indirect could cost you thousands and thousands of dollars of compounding growth, which is why you should actually, when you're thinking about that, sit down with a professional, okay? And I tell you why so many people still get it wrong. This is huge. A lot of people get it wrong. And why does this mistake keep happening? And you hear about it all the time. You probably have someone in your family, oh, I moved my money and a lot of things happen. But I tell people, honestly, it's confusion. The biggest problem I see when I sit down with my clients is confusion. Most people, they just don't handle rollovers very often, meaning, they don't understand it. If you don't do everything on the regular, it's not something that's really quick. And every employer, it has a different process. You may have rolled over from one job to another job easily, but now from the new job to that third job, it could be completely different. Some people, they send paper checks by default unless you request a direct transfer. So I had someone had that happen. So you have to request it. Look at that. Some other folks, they said, don't worry, we'll mail the check to your new provider, right? They'll do that. But then when they mail that check to the new provider, they still make it payable to you. And that single delay is what triggers that withholding. So yeah, your company, your old company will mail it to the new company, but they address it to you. Bam. That's why I always say working with a professional during a rollover, folks, is key. It is so key because it could cost you so much time. You need someone that knows the language. It's like a doctor. You go to a doctor, your regular MD, but if something's wrong, then you go to a specialist. Same exact thing. Go to a specialist that knows what they're doing. That way you can stay qualified from start to finish so you're not getting hit with these things. I see it all the time when I'm reviewing clients that did it in the past. When we're looking to do this, save so much time. And then a lot of them, when they roll it over, they choose annuities. I've been talking about on my channel a lot, annuities. People aren't sure what really should be done. So I say this, once you complete and do a proper direct transfer and you know how to do that right, the question is, where should that money go? A lot of people may want to, put it to a new 401k, right? Some people may do it in a 403b if that's where everything is. Some people are doing an IRA, but then some people like to do fixed index annuities. Now, here's why fixed index annuity rollovers, they work so proper, okay? Because your funds, first off, when you do a fixed index annuity, your funds, they remain tax deferred, okay? And then your principal is protected from market loss. So you just move your money to a new strategy that doesn't take market losses. So you could get limited growth. You're not going to get all the growth inside of annuity, but you're not going to have all the losses because it's an index strategy. So you get to reflect the market, but not be in the market. So I'll tell people, once you have those, it's a great strategy. But the good thing is you could turn it into guaranteed income. There's a lifetime income within your annuity. So even after all the money's done, it's still going to pay out. So that means not only are you avoiding not paying IRS penalties, you also could create, right, a structured, a supplemental income, something that's stable that you could plan for the rest of your life. So you have a little bit of Social Security, you have a little bit of your fixed index annuity, right? They did a study, 2024, right? Rollover based annuities right now represents over 60% of all new fixed index annuity contracts. So most people that have annuities, they're rolling it over. So people want the comfort, they want that protection, they don't want to have surprises. 2022 market was down 19%. You don't want that surprise. That's where it comes in. So let me give you guys I'm gonna give you an example of someone that I sat down with in September. All right, this client of mine, they had $300,000 in an old 401k plan, right? They were there for, I can't remember, like literally like 23, 24 years. They had 300,000, right? And they decided to roll everything over, but the check came to them personally. Or this is before we sat down. Check came to them personally, so the employer withheld about $60,000 in taxes. So they only got 240,000. Okay, so they're already pissed off. And they only have, like I said earlier, they only had 60 days to redeposit, right? So they were like, look, I'm not going to have those funds. What's going to happen? Now I'm going to owe. They said, you know what? I don't even want to do that anymore. So now they're going to have taxation, right? Now they're going to have taxation on that 300,000 because they were so mad. All right. So now that's considered income tax since the whole thing went. This is before we sat down. 300,000 is going to be considered taxable income. Luckily, they don't have a 10%, right? But we're talking, look, they created so much problems, all because that it wasn't even their fault. The company sent the check to them. They never knew about it. So they just said, hey, I think this is how it's supposed to come out. You know what I mean? But I told them, I would say, look, man, look, Mr. and Mrs. Client, if you had done the smarter route, if you requested that direct rollover, okay, that whole 300,000 would have gone straight from your 401k into a fixed index annuity strategy. The whole thing. We would have rolled everything over, no withholding that 60 grand, right? There would have been no 60-day rule. They wouldn't have to worry about that. There'd be no penalties. There'd be no taxable income, all right? Just continuous tax deferred growth. So they wouldn't have had to worry about that. All because it's a 50-50. The company didn't mess up, but they didn't know because most people just don't understand. So you see the difference? They have a hassle, all this money problems when they could have done something very simple, all because they really didn't know. And that's what, when you're here on my channel, I want to at least educate you guys on all these things, right? So the annuity, I would say, is it's a tax advantage. It's a tax advantage of doing everything right. So when you complete your rollover correctly, okay, you're also going to preserve what I call one of the most powerful tools, okay, and that's tax deferral. You want to make sure you're keeping things tax deferred. That means you're not paying taxes each year on the earnings. That is so huge, right? And the reason why they say it's so huge, Morningstar, great information. Morningstar last year, 2024, said uninterrupted, all right, tax deferred growth increases your total return anywhere between 25 to 40% over 30 years. So not having a break is giving you an extra 25 to 40% bump up, not trying to worry about taxable events, okay? So even if the market performs exactly the same way, you're coming out ahead simply by avoiding unnecessary taxation. And that is killing people. It's not about how much money you make, it's about how much money you keep. All right. That's why the best investors out there, okay, they don't just chase the returns. They're not just chasing the get rich quick. No, you want to make sure you're managing the tax side of the equation to make sure that you have the precision to understand exactly what's going on. So now I want to break down the myth. All right. Like I say, the man, the myth, the legend. Well, here's common rollover myths. Okay. I just want to clear these up. So if you want to do more research, check my page or check other pages. But here's the common myth of when we're talking about rolling over. Okay. Now, number one, if you leave your 401k with your old company, it's safer. Well, folks, not necessarily. Just because you're not there doesn't mean necessarily it's safe. You might have limited investment options. They may only give you certain options that you could have. They may have higher fees. You have no idea because you don't work there anymore. Okay. Another myth a lot of people think is that their employer automatically rolls it over for you. No, it's not. That's very rarely true. Why would they do that? Why would they, you don't work for them no more? Why would they go through all that issue to help you out? No. You have to initiate the request and specifically ask for it to be a direct transfer, or else it's going to be a long issue. Then some people say another myth, it doesn't matter if you miss the 60-day deadline. The IRS is going to forgive it. That's not guaranteed. Trust me, folks. The IRS, now they can grant you exceptions, right? They can grant you exceptions to everything, but you have to prove reasonable causes, okay? And then you got to file special paperwork to get a lot of that stuff with to be exceptions, okay? So I tell, look, it's better to just get it done right the very first time, folks. Very first time that you want to do a rollover, do it correctly. Don't do it indirect. Don't count on the own company. Do it yourself and have someone there with you. Okay. So just to recap, to finish this up, I want to keep it in plain English so everyone understands. Okay. If, listen to me, if your rollover check is made payable to you, the employer is going to withhold 20% for taxation, federal taxation. You then have 60 days, okay, to redeposit the full amount or face taxes and penalties. 60 days, all right? And then the fix to do that is either a simple request, a direct trustee to trustee transfer, okay, under the IRS Section 402C. Very simple. So you won't have to worry about all that stuff. Okay. And then fixed index annuities is a great strategy, or IRAs. If you want to do everything, move it to keep it tax deferred and protected pretty much. Okay. Doing it right, like I said, it could save you thousands, save you tens of thousands, and help keep your retirement growth uninterrupted. Because, like they said, Morningstar said, 25 to 40% more growth if you have uninterrupted pretty much effects or uninterrupted taxation. So rollovers don't have to be risky, but they do require precision. That's why a lot of times, folks, it's not really understood. A lot of people don't talk about rollovers or annuities because it's very complex. And if you don't know how to do it, it could actually be very difficult. Right. So I always want to leave you guys with a call to action. If you change your jobs, if you retired, right, or if you still have old accounts somewhere, you don't even know about it, don't wait to have a costly mistake to happen. Do something right now. All right. For those that want to talk with me, you could check in the description. You could schedule a one-on-one consultation. Make sure you guys like, follow, and subscribe for the page. But ultimately, make sure you do the correct research because we're talking your retirement. A lot of money for most folks. They're only money for a lot of folks for retirements. So make sure you're doing it correctly. Make sure it's handled 100% done correctly. Tax-free, whether it's an annuity or IRAs, whatever you're doing. Like I said, you could reach out to me. We could schedule a consultation. Make sure you check the links in the description to get yourself a free budget and to ask any questions you guys could ask away. And if this message has been good, make sure you don't forget to like, comment, subscribe to the channel. You're here with Retire with Earl, and I'll see you on the next one.